In part 4 of our video series, we'll talk about some additional considerations about accounting for plant assets and depreciation. Plant assets are purchased and disposed of at various times. When an asset is purchased or disposed of at a time other than the beginning of the year or the end of an accounting period, depreciation is recorded for just part of a year. This is done so that the year of the purchase or the year of disposal is charged with its share of depreciation. To illustrate, assume that the shoe machine we looked at earlier is purchased and placed in service on October 8, 2014, and the annual accounting period ends on December 31st. Since this machine is purchased and used for nearly 3 months in 2014, the calendar year income statement should report depreciation expense on the machine for that part of the year. Normally, depreciation assumes that the asset is purchased on the first day of the month nearest the actual date of purchase. In this case, since the purchase occurred on October 8, we assume that October 1st was the purchase date. This means that 3 months of depreciation is recorded for 2014. Using straight-line depreciation, we compute 3 months depreciation by multiplying the annual depreciation by a fraction where the numerator represents the number of months of use and the denominator is 12. In this case, the fraction is 3/12 and results in depreciation expense for 2014 of $450. Depreciation is based on estimates of salvage value and useful life. During the useful life of an asset, we may get new information and decide that our estimates are inaccurate. If our estimate of an asset's useful life and/or the salvage value changes, what should we do? The answer is to use the new estimate to compute depreciation for current and future periods. In other words, we only change depreciation going forward. We never restate prior periods for changes in estimates. This means that we revise the depreciation expense computation by spreading the cost yet to be depreciated over the remaining useful life. Let's return to the machine we discussed previously in our example about straight-line depreciation. Assume 2 years ago we estimated a 5-year life and a salvage value of $1,000. At the beginning of this asset's third year, its book value is $6,400, computed as $10,000 minus $3,600 in accumulated depreciation. Assume that at the beginning of the third year, the estimated number of years remaining in its useful life changes from 3 to 4 years, and its estimate of salvage value changes from $1,000 to $400. Straight-line depreciation for each of the 4 years remaining is computed by subtracting the revised salvage value from the current book value and dividing the result by the new remaining life. Thus, $1,500 of depreciation expense is recorded for the machine at the end of the third through the 6th years, each year of its remaining useful life. Total depreciation expense will equal $9,600 over the asset's life, $3,600 in total for the first 2 years, and $6,000 in total for the last 4 years. On a different topic, after a tangible long-lived asset is purchased, a company may incur additional expenditures over the course of an asset's life to maintain or enhance its operation. In recording these expenditures, it must decide whether to capitalize or to expense them, and to capitalize an expenditure is to debit the asset account. The issue is whether these expenditures are reported as current period expenses or added to the plant assets cost and depreciated over its remaining useful life. Revenue expenditures, these are on the top row here, they're also called income statement expenditures and are additional costs of plant assets that do not materially increase the asset's life or productive capabilities. They are recorded as expenses and deducted from revenues in the current period's income statement. Examples of revenue expenditures include ordinary repairs and cleaning, repainting, adjustments, oil changing, and replacing small parts of a machine. Capital expenditures, also called balance sheet expenditures, are additional costs of plant assets that provide benefits extending beyond the current period. They are debited to asset accounts and reported on the balance sheet. Capital expenditures increase or improve the type of or amount of service an asset provides. And capital expenditures are of two types. They include betterments and extraordinary repairs. And these are shown on the bottom row of the screen. Betterments or improvements are also the type of expenditure that make a plant asset more efficient or productive. A betterment often involves adding a component to an asset or replacing one of its old components, with a better one and does not always increase an asset's useful life. An example is replacing manual controls on a machine with automatic controls. One special type of betterment is an addition, such as adding a new wing or a dock to a warehouse. Since a betterment benefits future periods, it is debited to the asset account as a capital expenditure. The new book value, less the salvage value, is then depreciated over the asset's remaining useful life. Extraordinary repairs are expenditures extending the asset's useful life beyond its original estimate. Extraordinary repairs are capital expenditures because they benefit future periods. Their costs are debited to the asset account as well. As we've discussed previously, a company's assets are used to generate sales and earn income. Managers devote much attention to deciding what assets a company acquires, how much it invests in assets, and how to use assets most efficiently and effectively. One important measure of a company's ability to use its assets is total asset turnover. Total asset turnover is equal to net sales for the period divided by average total assets. The average total assets is computed by taking the beginning balance of the total assets, adding the ending balance, and dividing the result by 2. It's safe to say that all companies desire a high total asset turnover. Like many ratio analysis, however, a company's total asset turnover must be interpreted in comparison with those of prior years and of its competitors. Interpreting the total asset turnover also requires an understanding of the company's industries and operations, including whether a large amount must be invested in assets to generate sales. In our next series of videos, we will talk about how to account for asset disposals.